Hello. Tonight we're going to talk about Chapter 10, Strategy and the Master Budget. I'm using the book's notes, but I have my own notes as well, and I'll put those up for you if you want to look at those. I'll put those up on Blackboard, but I won't have any narrative to go along with those. All right, so in this chapter we're going to look at the role of budgets in the organization, the importance of strategy in building your budget. We'll outline the budgeting process. We'll actually prepare a master budget. The master budget we'll be preparing is actually from your textbook. We'll deal with the uncertainty in the budgeting process. For instance, when you have participative budgeting processes, there might be some uncertainty, and also there may be uncertainty in determining what your cash inflows are or what your sales is, your sales forecast. We'll look at budgeting service companies and some unique characteristics there. Some alternative approaches to budgeting, such as zero-based budgeting, ABB, activity-based budgeting, Kaizen budgeting. We'll look at some various behavioral considerations in budgeting, such as budgetary slack, which you may have heard of. So budget just basically is a detailed plan. It's a plan for the acquisition and use of financial and other resources over a specified time. Particularly, usually it's a year. In this chapter, think of the budgets are all a quarter, 1 quarter. So budgeting is just a process of preparing one or more budgets. So your budget should be, if it's going to be successful, should be tied to your strategy. So our long-term plan normally requires what are we going to do in the next 5 to 7 years. So what products will be entering into the market? What new markets will we enter? What types of approaches are we going to use with technology? So we express these strategic goals and long-term plans in the master budget as well as the capital budget. So 2 types of budgets within the master budget. The operating budgets are those that we use to run our operations. So sales budget and production budget and material, labor, and overhead budgets are all considered operating budgets. Then financial budgets are those budgets that look at our financial position. So the cash budget would be a financial budget, as well as your budgeted financial statements, budgeted income statement, and budgeted balance sheet. So the budgeting process normally might start with a budgeting committee, which would be our budget committee, which would be made up of managers, higher and lower level managers throughout the organization. We normally do it for a year. Budget is normally for 1 year. Normally operating budget is 1 year. We normally have specific guidelines that we need to follow. There may be a negotiation process, particularly if there's a participative budgeting component. And then the budgeting is kind of a feedback loop, so there's always going to be revisions to the budget as we go along. So the master budget, we might consider that our grand plan. What are we going to do in the next upcoming period with respect to sales, inventory, labor, materials. So we'll look at our short-term objectives. We're going to sell 5% more inventory, and we'll turn those into action steps. At the end of the budgeting process, we'll prepare budgeted financial statements. Sometimes those are called pro forma financial statements. The budget should also communicate. Types of these action plans should be communicated to employees and managers, and we should be able to use the budget to help coordinate some of the activities that we do in the firm. All right, so the operating budgets, sales budget, production budget, labor, material, overhead budget, inventory budget, those will culminate in a budgeted income statement. Then the financial budgets will culminate in the budgeted balance sheet, so the cash budget, and cash receipts, cash outflows, and cash budget will all culminate in the budgeted balance sheet. So 3-step process, we'll look at bottom line information. So what are the sales for the upcoming period? All right, what is the sales a function of? So it might be sales times budgeted units, and then we'll put together the information in a way that's easy to understand. So let's first start with the sales budget. Sales budget is the starting point of the master budget and shows forecasted sales in units and dollars for an upcoming period. It has two components, the forecasted sales volume and the budgeted selling prices. So if I determine that my forecast is 20,000 units and my budgeted selling price is $30, then my April sales budget is $600,000. Production budget is shown in units, and this would be my sales in units, plus ending inventory because I need to build that, but I can deduct out my beginning inventory because that's already been built. So let's look at a carry example. We have beginning inventory of 5,000 units. Desired ending inventory is 30% of May's projected unit sales, so 30% of 25,000. And then we want to add the sales for April of 20,000. So sales for April, budgeted sales for April of 20,000. The ending inventory would be 7,500, which is 30%, times 25,000 units, or May sales in units. And then I subtract out the beginning inventory of 5,000. Notice that the beginning inventory for the period, like for May, is the previous period's ending inventory. So here is a visualization of a production budget for second quarter of 2019. So April, I just showed this, was the budgeted sales for April plus desired ending, which is 30%, 25,000, less our beginning inventory, which was given. For May, the beginning inventory would be April's ending inventory. For June, June's beginning inventory would be May's ending inventory. Two required budgets for materials, the usage budget, that's shown in your textbook, so we're not going to cover that, and the purchases budget, which I will cover. So the usage budget is Exhibit 10.5 in your text. You might want to take a look at that because I think you have a pretty substantial master budget where you probably will have to do a material usage budget. So this shows basically the budgeted and unit cost of materials used during the period. So it's based on units produced. So we'll look at, for materials used, we'll take units produced, maybe multiply it times 2 or 3 if we use 3 units for every units produced, and plus my desired ending inventory for production minus my beginning inventory for materials used in production. So plus ending, less beginning. All right, the purchase budget shows how many units and dollars were purchased. So the units plus the dollars that were purchased, the amount in cost of what was purchased. So let's take a look at let's take a look at the material purchases budget. So we first look at the production needs for material in pounds. Okay, so it might be 2 pounds or 3 pounds per unit. Then we'll add our ending inventory and subtract beginning inventory. We don't need the beginning because it's already in the storeroom. We have to add ending inventory because that's our desired ending inventory, so we want to have a kind of a cushion or a buffer. And then the amount of material purchases, in this case 68,900, so it's materials needed, so that might be on your budget number of units that we're going to produce multiplied by 3, which is number of units needed in production. And then we'll add our ending inventory and subtract our beginning inventory of raw material inventory. And so that gives us 68,900 multiplied by the budgeted price of $245. So material costs for April are $168,805. I wanted to show you here, it shows the inventory amounts for the quarter. 10,800 is your ending inventory, 7,000 is your beginning inventory for the quarter, so be careful that don't add these inventory values up. Just read it, right? This is my ending inventory, so that's 10,800 at the end of June. And the 7,000 inventory is the inventory on April 1st. All right, direct labor budget helps us in planning direct labor resources. In this case, we've got 2 types of labor resources, skilled and semi-skilled. So again, we're going to start with the production budget and go from there. So here's just a couple things you need to know: that we have 0.5 hours of semi-skilled for each product and 0.2 hours of skilled labor for each product. So here's my semi-skilled labor budget. So again, we start with units produced. It's 22,500. It takes 0.5 hours to produce each unit, 0.5 hours of semi-skilled. So I need 11,250 of semi-skilled. Cost is $8, so 90,000 would be my wages for semi-skilled. We do the same thing for May and June. And then for the quarter, you can just sum these values up. For skilled labor, it's just 0.2 hours. Again, we multiply it by the production value of 22,500. So I need 4,500 hours. I'll multiply that by $12. So my total wages for skilled labor is 54,000. Semi-skilled was 90,000. So the labor budget is 144,000. All right, cost of goods manufactured and cost of goods sold. So remember, cost of goods manufactured is just your material, labor, and overhead. So it's going to be your material used plus labor plus overhead. So 422,625. So from three budgets, these are the labor budget we produced in previous slides. The material and factory overhead budgets are in your text. So we take material, labor, and overhead budgeted amounts, add those together. That's my cost of goods manufactured, my budgeted cost of goods manufactured. All right, so I'll add beginning inventory and subtract ending inventory to get my cost of goods sold. So beginning inventory, because I have 5,000 units, and the cost of material, labor, and overhead is $18 per unit, and that's from your text. So I take 5,000 times $18. I have 90,000 is my beginning inventory. So I'm going to add that. So I got goods available for sale of 512, 625. Then I'll subtract out my ending inventory of 140,875. So number of units in ending inventory times the rate of $18 per hour. Then we'll do a selling administrative expenses budget, which includes all planned selling and administrative expenses, includes depreciation. So that budget, if you wanted to find the cash outflow, selling administrative expenses, you'd have to take the depreciation out, because depreciation does not reduce cash flow. Here's a cash receipts budget, and this is part of the cash budget. So we're going to do this for April. So we've got cash and credit card sales of 70% of total sales, and credit sales of 30% of total sales. So April had sales of 600,000. Okay, so the cash sales were, and this is in the text tells you this, was 60% of this 420,000. The credit card is the other 40%. Notice that we only multiply that by 97%. And that's because there's typically a fee that goes along with credit cards. So 3% of a bank charges 3% of the proceeds from credit card sales. All right, some of them charge less, some more. I think Discover charges stores a little bit less. American Express charges stores a little bit more. So some companies, restaurants, may not take your American Express card because the amount is too high. The fee is too high. All right, then collections of receivables. So within the discount period, it's from this month, credit sales, the month before this month. So within the discount period meant they pay within 10 days. So we're going to multiply that by 98% because we have 2% sales discount that we give to our customers if they pay in a timely fashion. All right, so I multiply. So I have credit sales of 180,000 for April and 135 for March. So the prior month's credit sales, so we're looking at March's. So it's 80% of this 135 is within, this 80% of this 135 was paid in April. So in other words, 80% is paid of March's credit sales are paid in April. And 2% was a 2% discount because 60% of the 80% that was paid. So 80% of this 135 was paid in April. 60% of that was paid within a discount period. 40% was not. And then 2 months prior, we had credit sales 2 months prior, and so there's no discount on that. So 20% of this of February sales are paid in April. Okay, so 20% of those credit sales are paid in April. And we multiply that times 75%, and we end up with 18,000. So 539,664 is my cash receipts. So cash budget is going to typically be a summation of our other budgets. So I've got cash balance at the beginning of the period, 75,000. That's given. Operating cash inflows. That's from this previous budget of 539,664 down here, which we just computed. Cash payments for direct material purchases, 163,283. That is shown in the text. Direct labor, I believe it's 10.5. Direct labor was 144. We did do that budget earlier. Factory overhead in the textbook was 83,600, and then selling administrative expenses were 139. So net cash flow from operations were 9781. All right, so net cash flow from operations 9781. So in April, I had beginning cash balance of 75,000, net cash flow from operations of 9781, cash balance of 84,781. Had no financing activities, no need to borrow because we're above our minimum balance. And then prepare a budget, income statement, and balance sheet. It's the same as you would prepare an income statement or balance sheet for financial reporting. All right, I'm going to stop here, and I'll have these slides up and also have my notes up as well from this chapter. All right, so I hope everyone has a good night, and I will talk to you soon.